For car buyers, the headline looks almost too simple. Electric cars are finally getting cheaper. In 2025, the average selling price of new energy vehicles fell by more than 10% across the world's three largest EV markets, and China saw one of the sharpest drops. Battery pack prices kept falling as well, down more than 8%, with some lithium iron phosphate packs dropping to about $84 per kilowatt hour. In practical terms, that means cars that once felt like premium technology started moving into the same price zone as traditional gasoline vehicles. Good news for consumers, absolutely. But for investors, suppliers, and automakers, the story is much less comfortable. The mistake is to assume that lower prices mean the entire industry has become more efficient and more profitable. That is not what the numbers show. What is really happening is a redistribution of profit across the entire EV supply chain. Some automakers are selling more cars while making less money per car. Some battery material companies are shipping more volume while bleeding cash. Meanwhile, a few battery giants and vertically integrated car makers are still protecting margins because they control scale, technology, and global channels. So the question is not simply who sold the most EVs this year. The better question is who is capturing profit, who is subsidizing the price war, and who has enough cash to survive the next round. Start with the most visible layer, the consumer price cut. By 2025, China's new energy vehicle market was no longer in the easy growth phase. Sales were still large, but the growth rate had slowed sharply from around 20%, and analysts expected another major slowdown in 2026. When a market moves from expansion to saturation, competition changes. In the early stage, companies fight to educate customers. In the mature stage, they fight to take customers from each other. That is when price becomes a weapon. Entry-level EVs that previously sold above 200,000 yuan, roughly the high $20,000 range, were pushed below 150,000 yuan, or close to $20,000. For a young first-time buyer, that changes the decision completely. An EV is no longer a futuristic upgrade. It becomes a realistic alternative to a Toyota Corolla, a Honda Civic, or a used Tesla Model 3. But every discount has to be paid for by someone. Sometimes it is paid by the automaker through lower gross margins. Sometimes it is pushed upstream to component suppliers. Sometimes it is absorbed by battery material producers who keep factories running even when selling below cost. The result is a quiet but brutal transfer of profit. Consumers capture part of it through lower retail prices. Large automakers capture part of it through supplier pressure and scale advantages. Battery leaders capture part of it through global volume and cost control. Smaller material suppliers often get left with the weakest bargaining position. CATL is the cleanest example of this asymmetry. In the first quarter of 2025, CATL reported net profit of 20.74 billion yuan, more than the combined profits of BYD, Geely, and Chery. That is not a normal supplier story. It reflects the economics of a global battery champion. Massive scale, deep customer relationships, strong technology, and a diversified international footprint. At the same time, many lithium iron phosphate material producers were operating under heavy pressure. According to the IEA's Global EV Outlook 2026, part of the 8% decline in battery prices came from losses absorbed by upstream cathode active material producers. In plain English, battery prices did not fall only because technology became magically cheaper. Some suppliers were effectively financing the discount. This is why the EV price war should not be read as a simple consumer victory or a simple automaker strategy. It is an industrial balance sheet event. Since 2023, many cathode material producers have been losing money. In 2025, lithium carbonate prices fell sharply as EV sales growth slowed and geopolitical uncertainty increased. Lithium futures dropped hard in March 2025, sending pressure through the supply chain. For automakers, lower lithium and battery costs helped reduce the pain of price cuts.
对于材料供应商来说，它减低了定价权，并且压缩了利润。同一个数据点，在一家公司看来是好消息， 但在另一家公司却是坏消息。
BYD shows the second layer of the story, scale. In 2025, BYD remained the world's largest new energy vehicle maker, with global sales reaching 4.6 million vehicles. Domestic sales fell 7.8% to 3.55 million, but the company still held a powerful position because of its vertically integrated structure. BYD produces roughly 75% of its components internally, including batteries, motors, and electronic systems. That gives it a cost control advantage that most automakers would envy. Revenue reached 804 billion yuan in 2025, up 3.5% year-over-year. Yet even BYD could not fully escape the pressure. Its gross margin stayed around 20%, but net margin fell from 5.2% in 2024 to 4.1%, and net profit declined 19%. That tells us something important. Even the strongest players are not immune to price competition. They are simply better equipped to survive it. BYD chairman Wang Chuanfu described the industry as entering a decisive battle phase and asked suppliers for another 10% price reduction in 2025. That request was not just cost management, it was a signal of bargaining power. When an automaker sells millions of vehicles, suppliers cannot easily walk away. They may complain, but they still want the volume. Smaller automakers do not have that leverage. They face the same market discounts, but with weaker purchasing power, weaker distribution networks, and less room to absorb mistakes. The reason automakers accept lower margins is that they are not only selling cars, they are buying market position. A larger installed base gives them retail presence, after-sales density, driver behavior data, software upgrade channels, and future subscription opportunities. In the United States, investors understand this logic from companies like Amazon. Sacrifice margin today, dominate the channel tomorrow. In EVs, the channel is not just a dealership or a website. It is the car itself, connected every day, collecting usage data, receiving over-the-air updates, and potentially selling software services for years. Tesla has been operating with this logic for a long time. Its vehicle gross margin fell to around 15% at one point, and global deliveries declined 7.4% in 2025. On the surface, that looks like deterioration. But Tesla's direct sales model, supercharger network, software ecosystem, and full self-driving subscription revenue still give it an asset that traditional automakers struggle to replicate. FSD is not just a feature, it is a recurring revenue option attached to a fleet. If even a modest share of owners subscribe, software can change the economics of each vehicle after the initial sale. That is why delivery volume alone is an incomplete metric. XPeng provides another useful case. In the fourth quarter of 2025, XPeng reported net profit of about $55 million, reversing earlier losses. A key reason was the rising contribution from software and services. This matters because hardware competition tends to pull margins down, while software can create higher margin layers on top of the vehicle. The same physical car may be sold at a thin margin, but if the company can sell autonomous driving functions, premium connectivity, or recurring services later, the lifetime economics improve. That is the escape route from pure price competition. Now consider the third layer, battery cost. In 2025, average global battery pack prices fell to about $108 per kilowatt hour, while some LFP packs reached about $84 per kilowatt hour. This was a major relief for automakers because batteries remain one of the most expensive parts of an EV. Lower battery costs make it easier to cut sticker prices without destroying vehicle margins completely. But once again, the benefit is unevenly distributed. Automakers gain flexibility. Consumers gain affordability. Upstream producers lose bargaining power. The pressure is especially visible in cathode and anode materials. The IEA noted that battery price declines were partly supported by losses at cathode active material producers. Many LFP producers, with exceptions such as Hunan Yuneng, were expanding capacity while struggling with profitability. That sounds irrational until you look at the incentives. If a supplier stops production, it loses customers, factory utilization, financing support, and future market share. If it keeps producing at weak margins, it may survive long enough for weaker rivals to exit. This is the classic problem of overcapacity. Everyone knows the industry needs discipline, but no individual company wants to be the first to retreat. Some observers argue that material companies can solve the problem through technology improvements. That is partly true over a long enough horizon. Better processes, higher yields, and improved chemistry can restore margin. But in 2025 and 2026, the immediate reality is harsher. Capacity expansion, falling lithium prices, slower EV sales growth, and export policy uncertainty all make it difficult for smaller suppliers to regain pricing power quickly. Companies such as Goshen and Sunwoda may improve margins gradually through sales growth and operational efficiency, but they still operate under strong price pressure from automakers and battery customers. In this environment, volume growth without pricing power is not enough. The fourth layer is where the industry starts to separate into two groups: those trapped in hardware deflation and those building software advantage. In 2025, intelligent driving and software configuration became the new competitive battlefield. The reason is straightforward. If every company can offer a cheaper battery pack, a larger screen, faster charging, and acceptable range, then the product starts to commoditize. Once that happens, price becomes the default weapon. To escape that trap, companies need differentiated technology that consumers are willing to pay for and that competitors cannot copy quickly. Tesla's FSD subscription business is one example. Waymo is another, but with a very different model. Waymo had already generated about $355 million in revenue and was expanding its commercial robotaxi operations. By 2026, it planned to expand to 11 markets and reach more cities by year-end. The economics are still difficult. Waymo vehicles have been estimated to cost more than $120,000 each, while Tesla has targeted robotaxi vehicle costs below $30,000. That gap matters because autonomous mobility is not only a technology race, it is a unit economics race. The company that can deploy reliable autonomy at lower hardware cost will have a very different profit ceiling. Robotaxi is not guaranteed to become a mass profit engine immediately. Regulation, safety, mapping, insurance, and consumer trust all slow deployment. But the direction is important. Automakers are trying to move from one-time hardware sales to recurring mobility and software revenue. If they succeed, the market will no longer value them purely as manufacturers. It will begin to value them partly as platform companies. That is the reason software progress has become central to EV valuation. China has its own version of this software race. Huawei's intelligent driving systems, including applications in vehicles associated with newer Chinese smart car brands, have helped push consumer demand quickly. For American viewers, think of the difference between buying a generic smart TV and buying an iPhone. Both are hardware, but the second one carries an ecosystem. In the EV market, the companies that build the strongest ecosystem may escape the worst of the price war. The companies that only assemble hardware will be forced to compete on cost. That leads to the fifth and most underappreciated metric: cash flow. In a boom market, investors often tolerate losses because revenue growth looks exciting. In a saturated market, cash flow becomes survival. A company can sell a lot of vehicles and still become more fragile every quarter if each sale consumes cash. This is the risk behind headline delivery numbers. Deliveries can rise because the company is discounting aggressively, financing inventory, extending payment terms, or pushing low-margin models. None of that guarantees value creation. Li Auto illustrates the warning. In 2025, its revenue declined. Net profit fell from 800 million yuan to 110 million yuan, and operating cash flow showed a net use of 860 million yuan. The company still had cash reserves of 5.67 billion yuan, which is meaningful, but the deterioration exposed a basic truth. Sales volume is not the same thing as financial strength. A company can look large from the outside while its cash conversion worsens inside.
对于投资者来说，这里就需要做出超越新闻发布的分析。你必须检查供业毛利、营业现金流、自由现金流、 库存周转率、应收账款和现金储备。
Imagine two EV companies. Company A delivers 500,000 cars but loses money on each one, burns cash every quarter, and depends on fresh financing to continue. Company B delivers 250,000 cars but holds stable gross margins, positive operating cash flow, and enough cash to fund R&D for several years. In a bull market, Company A may get more attention because the delivery number is bigger. In a tightening market, Company B is more likely to survive.
The EV industry is entering the phase where survival quality matters more than growth speed.
This is also why supplier pressure can become dangerous. When automakers demand lower prices from suppliers, they may improve their own short-term margins. But if the supply chain becomes financially unstable, quality problems, delivery delays, and technology stagnation can follow. The healthiest EV ecosystem is not one where every supplier is crushed. It is one where cost reductions come from real productivity gains, chemistry improvements, manufacturing learning curves, and scale efficiencies. A price war that simply transfers losses upstream can work for a while. It cannot be the foundation of a durable industry. It cannot be the foundation of a lasting industry. The sixth layer is overseas expansion. In 2025, Chinese new energy vehicle exports more than doubled, exceeding 2.5 million units, with Europe becoming a major destination. BYD exported more than 131,000 vehicles and pushed ahead with a factory in Hungary. This matters because overseas markets can raise the valuation ceiling of Chinese automakers. A company that only competes in China faces a saturated, hyper-competitive domestic market. A company that can export profitably, localize production, manage regulation, and build service networks has a much larger addressable market. But overseas expansion is not a free lunch. The European Union imposed anti-subsidy tariffs on battery electric vehicles at around 21%, creating pressure on pure BEV exports. Plug-in hybrids, however, had more room to maneuver, and companies adjusted their export mix accordingly. This is a key point. Tariffs do not simply stop trade. They change the route of trade. Companies may shift production to Hungary, Thailand, Mexico, or other markets. They may export different vehicle types. They may localize batteries or assembly. The winners are the companies that can adapt faster than policy barriers rise. For American investors, this should sound familiar. Trade policy has already reshaped semiconductors, solar panels, and consumer electronics. EVs are now part of the same geopolitical map. Tariffs, local content rules, battery sourcing requirements, subsidies, and national security concerns all influence valuation. Tesla benefits from local production in the United States, China, and Europe. BYD is trying to reduce tariff exposure through overseas factories. Other Chinese brands are looking for markets in Southeast Asia, Latin America, the Middle East, and parts of Europe, where demand is rising and policy barriers are more manageable. So, when evaluating EV companies, export quality matters more than export volume. Shipping cars overseas at thin margins just to report growth is not the same as building a durable global business. The better questions are, does the company have local service infrastructure? Can it finance vehicles for local buyers? Can it manage compliance and safety standards? Can it protect margins after tariffs, freight, warranty costs, and dealer incentives? Can it build brand trust outside China? A car sold in Europe or Brazil is not automatically more valuable than a car sold at home. It is more valuable only if the business model travels well. Now, step back and connect the pieces. The EV price war is changing profit distribution in 6 ways. First, end consumers are receiving real benefits through lower sticker prices. Second, automakers are using scale to capture channel power and data, even if that means sacrificing short-term margins. Third, falling battery prices relieve pressure on vehicle makers but squeeze upstream material suppliers. Fourth, intelligent driving and software services are becoming the escape route from hardware commoditization. Fifth, cash flow is replacing delivery volume as the core survival metric. Sixth, Overseas expansion and tariffs are redefining the long-term valuation ceiling. This framework also explains why the market can look contradictory. CNTL can be highly profitable while some battery material companies lose money. BYD can dominate global sales while seeing net margin decline. Tesla can report weaker deliveries while still being valued for software and autonomy. XPeng can improve profitability through services, even in a price war. Li Auto can have significant cash reserves and still face pressure if operating cash flow deteriorates. These are not contradictions.
They are evidence that the industry is moving from a simple growth story to a capital allocation story. There is also a broader macro layer. Interest rates affect vehicle financing. If car loans become more expensive, consumers become more price-sensitive. Commodity cycles affect lithium, nickel, graphite, and cathode materials. Trade policy affects exports. Software regulation affects autonomous driving. Insurance costs affect robotaxi adoption. In other words, EV investing is no longer just about whether people want electric cars. The answer to that is already yes. The harder question is which companies can manufacture, finance, update, service, and globalize those cars profitably. For individual investors, the practical conclusion is straightforward. Do not evaluate EV stocks by delivery numbers alone. Deliveries are the easiest number to market and the easiest number to misunderstand. Look at gross margin trends. Look at net margin. Look at operating cash flow. Look at cash reserves. Look at supplier dependence. Look at how much of the vehicle is vertically integrated. Look at overseas expansion quality, not just export headlines. Look at software revenue, subscription adoption, and autonomous driving progress. If a company is growing deliveries while margins collapse and cash burn accelerates, that growth may be a warning sign rather than a strength. The companies worth closer attention are those with at least one of three advantages. The first is vertical integration, which gives better control over cost and supply. BYD is the obvious example. The second is battery scale and global customer reach, where CATL remains central. The third is software and data advantage, where Tesla, Waymo, XPeng, Huawei-linked ecosystems, and other intelligent driving players are trying to build differentiated value. No single advantage guarantees success. But companies without any of these advantages will find it extremely difficult to escape low-margin competition. There is one final point. A price war can create the illusion of permanent consumer abundance. Cars get cheaper, features improve, and financing offers look attractive. But if the discount is funded by supplier losses, automaker cash burn, or unsustainable subsidies, the market eventually forces a correction. Weak firms exit, capacity is written down, brands consolidate. Surviving companies raise prices selectively or shift customers into software packages and higher margin trims. The consumer wins in the short term, but the industry decides who pays over time. By 2026, the most important documents in the EV sector will not be glossy launch presentations. They will be quarterly financial statements, export data, battery cost curves, and autonomous driving deployment updates. Watch whether gross margins stabilize. Watch whether operating cash flow turns positive. Watch whether overseas factories actually reduce tariff exposure. Watch whether robotaxi and driver assistance revenue becomes material rather than promotional. And watch whether suppliers regain pricing power or continue subsidizing the downstream price war. The EV industry is not collapsing, it is maturing. That distinction matters. In the early phase, almost every participant could tell a growth story. In the mature phase, only the strongest can convert scale into profit. The next winners will not necessarily be the companies shouting the biggest delivery numbers. They will be the companies that can sell affordable cars, protect cash flow, control core technology, monetize software, and expand globally without destroying margins. So the next time you see an EV price cut, do not stop at the consumer headline. Ask who gave up the margin. Ask whether the automaker gained durable share or merely bought temporary volume. Ask whether the battery cost reduction came from innovation or from supplier losses.
Ask whether software is becoming a real profit center. Ask whether exports are profitable after tariffs. That is where the real story is. And in this industry, the real story is no longer just about electrification. It is about who controls the profit pool after electrification becomes normal.